Hey everybody, welcome back. Okay, so I'm going to do a little cool video right now that is going to showcase my algo. And my algo is designed to save you or a lot of time in learning how to read order flow, because what my algo does is it tells you whenever something is undervalued by turning purple, the candles you'll see here, or overvalued by turning purple at a high. So undervalued would be turning purple at a low, overvalued would be turning purple at a high. And what I've done here is I put together, just to save you some time of learning how to read trend and everything, I put together two moving averages here. So I have a moving average, the big one in yellow or in orange, that is a 200-day, and the blue one is a 20-period moving average. Now, I should actually shout out to my friend Ray, who was using these moving averages as a way of simplifying. It's actually an old floor trader trick when we first came off the floor and we got to charts. Many of the floor traders back in the day, when they left the floor, would use nothing but a 200 and a 20-period moving averages, because it helped you understand what the bigger picture was. So what I'm going to do here is showcase how I'm going to use my moving averages along with my over and undervalued situation, and we're going to look at some actual trades. Now, just because the algo goes over or undervalued does not necessarily mean that you should just jump right in. It's a terrible thing to do. Obviously, we're going to need some price structure and some order flow, and in order to take a trade, we'll use some candle structure. So what I really want to see is I want to see a candle that is closing in the top 10% for longs, or a candle that closes in the bottom 10% for shorts. Okay? And we're going to use the trend here. We're going to use the moving averages. So whenever you see the moving averages that are flat, mainly the 200, and we're outside of a flat 200 moving average, like right here, this is a high probability trade because the trend is sideways. So we're in what we call a balanced market. And I have a 1 hour chart up here of the dollar CAD. I'm going to just throw it around with several charts here. And you can see here, so what we're looking for is we're looking for a candle that closes in top 10%. And what I ideally want is I want to see the next candle take out that high. So just because something closes in top 10%, like this candle right here, you can see right there, the next candle has to take out that high. So we get undervalued here. We do not get a trigger there. We do get a candle right there that takes out that high, and as you can see, it reverts back to the mean quite effectively in this situation. Okay. Here we get into an overvalued situation. There is a candle arguably that closes in the bottom 10%. It's arguable. We take out that low, and you can see that ultimately it does revert back to the mean. Ideally in this situation, because I have some structure over here, I'd probably wait for this candle right here to close in the bottom 10%, and we go back down to the mean. Now, here's a context where we get undervalued. It closes in the top 10%, and you can see it meddles around a little bit. Might have stopped you out there, but that happened to take you all the way back up to that move. kind of the exact situation here again, where we're now in this particular case we almost have a bit of a sloping EMA, and quite honestly I don't see any candle that closes in bottom 10% here. Nothing triggers. Nothing triggers. Now, just because nothing triggered doesn't mean a couple of candles later, if the context of the EMA stays the same, we can't take it. So this would be a very good trade here. And down she goes. Okay. Same story down here. Nothing closes in top 10%. You see this one here, arguably that would have been a trade, but it does not trigger long. It's not until we actually don't even get a candle that does close in top 10%, but ultimately we missed that. An idea here. Flat EMA, overvalued, and that one does not work. I'm going to show you them all, right? I'm going to show you the winners and losers. Okay. Now, again, we are still technically overvalued here, and there's a candle right there. Works out beautifully. Okay. Okay, here we go here. Now, see we have a slight upward sloping EMA, which is even better, right? Now that one would have got stopped out, but there's another candle right there. Works beautifully. Here's one that works right off the bat. Now this one I'm going to be very cautious of. The EMA is still kind of flat, but it's slightly upward bias, right? That one works out beautifully. See how it takes a little bit longer? And the reason it took longer is because that slight upward bias on that EMA. Okay, now again, here's a really cool situation that I really like when it happens. We have a trend that's moving higher, and we have an undervalued situation. Now a trade like this, I'm really going to love it. Nothing closes, unfortunately, in top 10%. So we have to wait, come down lower again, and ultimately you don't even get a candle here, unfortunately. You could argue that that candle there would have qualified and you could have taken a trade up there, but quite honestly I prefer to see the candle at the pivot low or the pivot high. Okay, let's just look at some other things here. Just looking at the last week in pretty much any pair. Okay, now here's another beautiful situation that I love. We have a downtrend. We get a candle right there that closes. Now technically that was a good trade right there. Unfortunately you probably would have got stopped out, but there's another trade right there. And that does not look like much, but that trade actually makes you 2-to-1 on your money. That's almost 3.6-to-1 on your money. Okay. We're up here. Now again, in this context, we have this sloping down EMA. So when I get up to this trade, I'm really going to like that trade. Now you can see it does not work. Unfortunately, that first candle that does close bottom 10% does not work. This doesn't work all the time, guys. Nothing is perfect. But here you have it up here, another candle that closes bottom 10%. And that one works out quite nice. You would have got easily more than 2 to 1 on your money there. And you might say, Steve, it might have stopped me out. That's okay. I might have even got back in right there. That one gives me 1 to 1 on my money. Not the best trade, but a good trade, depending on how you manage it. Now, here's a context that you have to be very careful with this. So now we have a downtrend, right? Now you see how the algo goes undervalued. This is a trade that I am going to take really small size in, or I don't want to fight that trend, right? Or I'm going to just look for a shorter term time period trade with a larger stop. So you can see here we get into this undervalued context in this downtrend. I might have taken a trade there, and in a trade like this, what I honestly would do, I would probably do 1 to 1 on my money. I look for 1 to 1 on my money, and I'd be really happy doing, like, instead of doing a 1% trade risk, I would do a 0.5% trade risk here. Okay, same situation here. We have a downtrend. And let's go long. Same story. I'd be really happy with 1 to 1 on my money. It gives me 2 to 1, you can see here, but there's 1 to 1. And again, I would do very small size. Now here's an interesting context. You want to pay very close attention when you have like triple divergence, and especially when you're far away from that 6. The 20, the further you are away from the 20 and the larger the gap between the 20 and the 200, the more likely it's going to have a larger reaction, because you're getting, this is overvalued, this is very overvalued, and this is undervalued, this is very undervalued, and this is extremely undervalued, right? So you can see here, see what I'm talking about? 1, 2, 3, there's your trade. In a trade like this, I would probably still do small size, but I would hold for more. And I want to show you something really cool. You can see that this had a small reaction, this had a bigger reaction, and this had a big reaction. I want you to get that in mind. Now, it doesn't always work like this. You never really want to be fighting a trend of any sort. In actuality, you want to be going with that trend. So, but they do work, and especially when you get overvalued, very overvalued, and undervalued, very undervalued, and extremely undervalued. Okay, just be careful of the slope of this trend, because if this slope of this 200 EMA is really steep, you got to be really careful. Okay. Okay, you get the idea. Here's one that I think has a. You can see something really interesting here. We were in a strong uptrend, weren't we? See this strong uptrend right here? Very, very strong. Now, it did work here. See that? See how powerful that was? Because this was really with that trend, wasn't it? Right? And this is a trade where I'm going to probably take quite a bit of size on this trade, because the uptrend is very, very strong. So you can see here, get long here, and on a trade like this, you can see it gives you 4 to 1 on your money beautifully, right back to that EMA, right? Now we're undervalued again, same type of context, right? But now you have to really pay close attention, because now we're deep underneath that 200 EMA. So you can see you get an instant reaction here, which would have made you some money, right? It does come down, but that's a trade that I would still take in this context, because of the strength of that trade. Ideally, we want to be looking for shorts in this situation, not longs, but just look at the strength of that move. Okay, and that works beautifully. Okay. So the takeaway here is this algo works really great in trending markets for continuations of the trend. When it gets undervalued, boom, undervalued, boom. Whenever you have a strong trend, like you're seeing here with big separation, and it's really sloping, it's the separation between the two that you really want to pay very close attention to. It's going to be harder, right? You can see here this overvalued situation. See how this came down with the previous trend before it? Okay. So I just wanted to showcase the algo. I'm trying to simplify my trading for the average person. Obviously, if you go to my website and you can afford my one-on-one mastery course, I don't even use the algo in my mastery course, okay? It's completely non-existent. You don't need the algo and you don't need moving averages. The algo is a bit of a lagging indicator, and so are moving averages. My one-on-one mastery course, if you think my algo is powerful at 360, wait till you see how powerful my one-on-one mastery course is. But I made the algo because what I wanted to ideally do was give people a way of making money if they cannot afford my mastery course. But one caveat I want to tell you about the algo. The algo really only works well on large time frames, and because the Forex market is a 24-hour market, it tends to work better on the Forex market. If we look at the same type of situations on stocks, it doesn't work so well with stocks on an hourly time frame, and if you're trying to use the algo on a 1 minute or a day trading time frame, it's just not responsive enough. So yes, it can be used to day trade, but ideally the algo is more of a mid-range trading process that is designed to get you to take a small account, use the algo, make some money, and then ultimately be able to afford my one-on-one mastery course. Because like I said, this algo is lagging. What I do in this course or in my video lessons, it's way faster and it's much, much more powerful. When I'm using the algo, obviously, I have to use wide stops. When I'm trading without the algo, I can use much, much tighter stops. And so my profits are much greater. But I wanted to showcase this to you, hopefully to give you something that if you cannot afford my full coaching, the algo indicator package is absolutely brilliant. And if you just want to swing trade, use 1 hour or daily charts, the algo is really great. Hope you guys enjoyed that. Thank you and bye for now.